A big FII selling, and as to how that's been a sore point for the Indian markets this year, and due to this the broader market also has been on a recovering end. Now that FIIs are beginning to position, or rather pare down their positions in that space. So before we get to this special voice on the show, who is not only an FII of Indian origin but also has a very keen eye on the stocks from the broader universe, Ajay Sharma, my research colleague, joins in for a quick peek on the guest who joins in next, and what are the factors that he's looking out for in particular when he monitors India. Ajay?
Well, good morning, Aisha. Today, of course, we've got a special voice on the show, Krishna Kumar of Eastspring. So, not only that he's an Indian origin fund manager, foreign fund manager, but he's been witnessing the evolution of Indian stock markets for over 2 decades. And his belief on India right now is that the valuation has still not become extremely cheap, and FII outflows from India may not ebb in any time soon, because valuations were steady and a lot of foreign fund managers had profits here on the table. But he also believes that at the same time, value approach of select stock picking is the way to go about investing in the markets. In fact, Indian markets have been on the receiving end because of macro worries, and now they seem to be tilting. But because on average valuations still are barely around the mean, he believes that it's the earnings improvement cycle which will decide the future course of the market. So very interesting insights coming in from this India specific emerging market fund manager. I am looking forward for that entire interview.
Okay, so let's connect with Krishna Kumar. It's it's ready to get him on television. So KK, good morning. Thank you for joining us. Now KK, let me first just talk about where we stand. We've seen a rather brutal selling in some of the mid and the small cap stocks. Mid and small cap stocks are down more than 35%. Now fundamentally, this market is not bad as what we saw in 2008, but yet the price action is really reminiscent of the kind of selling we saw in 2008.
Yeah, that's true, so we've been very concerned about valuations and also the way the mid and small have run up so hard. There have been also pockets of overvaluation on the back of earnings expectations. So the fact is, once the earnings are far more muted and more sedate, I think the correction is far more sharper and deeper. Think about it this way, that this is a more of a reality check that the market is going through, and my assumption is, in a bull market, always the correction is sharp and savage. I do not think that India is in a bubble zone, that the bubble has burst and things are over. It's a typical bull market correction where there is a reality check, there is a sanity check, and things kind of correct. And it's sharp and savage, that the freeloaders and the easy money will not be made anymore. So the valuation guys will come in and it will become a bottom-up stock pickers market, which is a sensible thing to be.
Now, KK, in the month of October, the selling from FIIs have been rather ruthless. We've seen about $2.5 billion of selling by foreign institutional investors. This is one of the biggest sell figure we've had in a long time. I mean, this number goes back to as late as October 2008, when the financial crisis happened. So, what explains this intensity of selling by foreign institutional investors?
So you must think about India market ownership, which is close to around 24-25% is owned by foreigners, which is the FII ownership. And these investors are also invested in other emerging markets which have been more volatile and have been also correcting quite sharply. India valuations held up pretty well because of strong domestic flows. India has become a narrow market, but the broader market is also kind of reasonably expensive. Now, when you lose money elsewhere, the chances that you will take profits off the table wherever it is available, and India is a market which was still standing up and waiting to be bought, waiting to be sold, whichever way you want to take it. And that is pretty rational for people to kind of say that. And also think about it, the currency weakness adds to the little bit of acceleration, that people don't want to lose too much money with the currency depreciation. And that spooked investors a little bit more, that the rush to the door was a little bit exaggerated in the process. So October was a month where people sold on the back of emerging market losses and also currency depreciation. So maybe it is one more month where you will see that, where there will be outflows and hence there will be selling.
Right, KK, but in general, just looking at the way how EMs have cracked so far and, the shake-offs and DMs are just beginning, do you think that this could be a very tough moment for equities in general, or do you think come October and September, that perhaps could be a great buying opportunity for long-term investors once the froth settles down?
I wish I had one answer for you, but the way I think about it is October was a reality check. And the reality check has just happened. Now, whether equity as an asset class is done and buried, I am not in that camp. I strongly believe that valuations will moderate. People will kind of come back, do a reality check. They will think about whether emerging markets are valuable at some point in time because of the kind of carnage that you've seen. But the fact is that India is still the most expensive or the highest premium to emerging markets, and that will make people sell India a little bit more because the premium at some point has to be justified with earnings or valuations which will support the prices. If either or is not true, then the fact is that emerging market route will be seen as a kind of an opportunity, and India will be sold into because the premium that it has.
KK, in the month of October itself, we've seen an FII sell figure of $5 billion. What is it that you're making of this FII selling? Irrespective of the past few trading sessions when they've actually turned net buyers, do you sense that this could very well be a temporary phenomena? I mean, are you making a case that FII selling in India is not done quite yet?
I'm not willing to forecast, but I suspect that people will rebalance their portfolios for two reasons. One is that the emerging market has corrected far more than the Indian markets, first. Second is the Indian market premium is significantly higher compared to emerging markets. And both these will cause for a little bit of correction in terms of how the portfolios get realigned. If the India portfolio looks suddenly significantly overweight, I guess there might be a little bit more coming behind.
Right, KK, do you think the markets have factored in the double whammy on the worst when it comes to crude as well as the rupee fall, or is there more adjustment to go?
So, the fact is crude at $80 results in a few things where we equate it with about 20 to 30 basis points on GDP and 30 to 40 basis points on current account, and maybe around 30 to 40 basis points also on CPI. If you put those numbers in order and if you put currency wherever it is, I think the currency bit is possibly done. The second part is how does the overall number shape up? We've seen a benign CPI number, which is inflation numbers have been pretty benign on the back of softer food prices, which is very interesting. And I would suspect if there is something structural there, I don't know about it. But the fact is that the inflation has not surfaced as much as we thought it would. So given all that put together, there could be cost pressures which would kind of percolate to the corporate, at the corporate level, which will mean that there could be earnings pressure in terms of, there could be a kind of revision in consensus numbers, part one. Second is there could be cost pressures which might have EBITDA pressures, which will result in lower earnings forecast that you would see rolling on to 19 and 20, which will mean that this market may see valuation support soon enough, because we've seen a large part of the market is corrected and a very narrow bit of the market has held up the broader indices. So I would suspect that the crude bit may be yes, but I suspect the rupee is pretty much done.
But how do you assess, the overall growth of credit in the market, given the NBFC situation? How do you think that has panned out? What's your judgment on the entire space right now? Do you think the worst is behind? Do you think that enough checks and balances have been put in place, or will the impact continue, especially for the MSME sector per se?
So that's one more bit, right? This is the third episode, which is the liquidity part. The liquidity bit has gone through a bit of a correction, and the correction has been on the back of what liquidity that the NBFCs have today. If you think about NBFCs, almost 26-27% of their total book is all short-term borrowings, which is with maturities of less than a year, which are CPs and NCDs maturing with a shorter duration of about less than 12 months. So it's a very short-term issue that you will realize that the liquidity crunch, as you see it now, will be more of a 3 to 6 month phenomenon, which can result in a lower credit growth. And lower credit growth will systemically result in a slower economy. Now, is that significant? If you think about the overall economy, NBFCs are about 23-25% of the total credit system. If that slows down by 10%, you would see a credit slowdown, but the credit slowdown is not adequate for you to believe that the economy is going to completely grind to a halt. It will slow down a bit, but it's more transient than permanent. The fact is that these things get washed out pretty quickly in 3 to 6 months time. Some NBFCs would get eliminated, and the fact is that the credit will come back to the banking system, because incrementally people will not lend to NBFCs, but they will get the money back in the banking system. And the banking system will see credit growth, and we are more optimistic that the credit growth or the next leg of credit growth will be driven by banks. And it's a good situation to be, because there's a valuation check, there is a reality check for these banks, or NBFCs, sorry, that things will correct, and it's a good correction. And the fact that banking system will come back much more stronger as they wash out their NPLs and past sins. They will possibly emerge much stronger to replace the NBFC's gain in market share over the last 3 years, which has been pretty, exorbitant, for want of a better word.
Now, in the past, you've owned NBFC stocks. Are you shifting a preference there within NBFCs to corporate banks? What I'm trying to understand from you, that how are you approaching within the financials as a category?
So just to correct you, we own no NBFC, and we had only one housing finance company, and we did not like the valuations of the non-banking financial corporations, which were trading at outrageous valuations. I mean, even now some of them are quite outrageous, because people are unwilling to reset the growth numbers. What we think is there is value which is coming up in pockets of the NBFC space where we're thinking positively. And also we are very strong, we strongly believe that we want to play the corporate credit recovery cycle through the banks. And if you think about it, we are less oriented towards retail credit growth in the banking space and more focused on the corporate credit growth in the banking sector. So we are kind of been waiting for this opportunity for this correction, if you may, because this was getting quite crazy, because some of the NBFCs were growing at about 45%, 50% over the last 3 to 5 years, and they were trading at 5 times book, 6 times book, and they didn't make any sense to us. And some of the retail banks, which had seen credit growth of about 25%, did not make sense to us, because they were pricing in valuations which did not make any sense to kind of chase them or acquire them or own them. And now valuations have become far more sober, and we are clearly cherry picking on the corporate credit cycle recovery.
Right. KK, one more sector where the foreigners have a large exposure has been consumer stocks, Unilever, Nestle's, ITCs of the world. But again, the debate is, what do you pick? Do you pick growth, or do you pick valuations which are still at historic highs? What is your own assessment of the risk versus return in consumer names?
No, we don't own any staples. Apart from maybe a couple of risk positions, we don't have any consumer staples. I do not own Hindustan Lever. We don't understand these valuations, and we strongly believe that when you do a market implied growth rate for arriving at a sensible valuation for these companies, they traded valuations which we don't understand. And obviously some people understand it better, because they kind of use different costs of capital to evaluate these companies, but we don't. So consumer staples is a no-go for us, even at these levels if they've corrected. it's a long way before we even take a look at it.
Right. What is your understanding of the trend on interest rates? Some of the auto companies are, of course, coming under pressure because of that. Give us a sense of how you see the outlook for the auto companies in a rising rate environment, and would that really punch a growth for the likes of Aisha and Maruti that have performed well?
Yeah, so we were underweight consumer discretionary as well as the entire sector, and we didn't understand the valuations and what kind of growth they were pricing in. It is now, in the last quarter, we have seen the correction of almost about 20-25% for the entire sector, agnostic of names. That gives us an opportunity to reevaluate, to think about more sober 10 to 12% kind of growth numbers. But also the fact that the disruption in the NBFC space, which were largely financing these consumer discretionary names, kind of have given us a little more time to think, because the funding will come back in a bit, and without funding for these discretionary names, it is going to be a while, or it could be a longer runway before they kind of recover in terms of growth numbers. So the names that you spoke about are interesting, and they have all corrected and come off their high stools. So it is interesting to kind of go out and look at the consumer discretionary space, which we are doing now.
All right, KK, thanks very much for taking out the time to speak with us. Really enjoyed talking to you and understanding your investment philosophy in the current market environment.